Hi guys, money saved is money earned. It's a very old saying, and in this video we will know more about it. Hi guys, my name is Karan and you are watching me on your channel. In today's video we will understand more about what is a mutual fund. What is the mutual fund? What are its advantages? How can we use it for our benefit? How will it impact my savings, etc. etc. Okay, so let's get started. So guys, very simply, mutual fund, as the name suggests, it's a mutual fund. It is a very professionally managed investment product where we have a fund manager who collects money from a lot of investors. These could be retail investors, institutional investors. So people invest with the fund manager, and the fund manager, he invests that money either in a debt instrument or equity shares or money market instruments basis the nature of the mutual fund. So very simply saying, mutual fund is a professionally managed fund where the fund manager collects money from the investors, and accordingly he provides returns to the investors. So the return is totally dependent on the market, how the equity market will work, how the debt market will function. However, the intention is to generate maximum return for the investor. Okay, so now we understand what is a mutual fund. So what are the advantages of a mutual fund? So guys, as I said, it is professionally managed, and the intention is to give a higher rate of interest to the investors. For example, a bank FD will give you, let's say, 6 to 7%. Okay. However, the investor, if they want more from the money, so they take the route of mutual funds where if they take calculative risk, they can easily make between 10 to 15%. So equity mutual funds, they have the potential to give a rate of return of 10 to 15%. A debt mutual fund, which will invest in different debt securities, let's say company deposits, bonds, government schemes, they have the potential to give between 8 to 9%. So accordingly, investors, they invest in these professionally managed funds. Fund manager and the asset management company, as we call them, they charge a small fees, a very small fees to manage your money, and they give us more return. So now the question comes, should I invest in mutual funds? Absolutely. The reason is that you have to beat inflation. Your fixed deposit will not have the potential to beat the inflation because you will be given 6% interest, and then you'll be charged taxes as well. 10% bank will charge, and the remaining you have to pay to the income tax department basis your tax slab. So the eventual rate of return will come down to 4.5%, which is very less as compared to the inflation, which is around 7 to 8%. So you need a financial instrument which will give you more than, let's say, more than inflation. So that has to be your mutual funds. So basis the stage where you are, you should invest in different type of mutual funds. Have a mutual fund portfolio prepared, take help from financial advisors, have some debt mutual funds, have some equity mutual funds, money market mutual funds, basis your stage, right? So we have understood what is the mutual fund, what are the advantages. So now I will broadly touch base on the types of mutual funds. So broadly, there are three types of mutual funds. One is the equity mutual fund, other one is a debt mutual fund, and the third one is money market mutual fund. In this video, I will just give you very briefly what are these three, and I will make a separate video to explain more about equity, debt, and money market. So guys, the number one and the most profitable mutual fund is called the equity mutual fund, where the fund manager will collect the money and invest in the stock market, different stocks basis the objective of the fund. So the good part about this is that this fund is that they invest in different stocks, and they spread the investment. For example, they invest in 50 stocks, so on every stock they invest 5% of the money, so your money is safe, right? If you invest all the money in one stock, there is a risk, but the fund manager will divide that money into, let's say, 50 stocks. So in a way, I'm investing in 50 companies. if I buy one unit of mutual fund, I am investing in 50 companies. Imagine, 50 companies will not go bankrupt. 50 companies will not, do bad financially. Some company will do good. Some company will do well. But your money is spread across a lot of companies. Basis the fund managers. Um Objective and discretion, which we already know. We know which all companies they invest. So number one mutual fund is a equity mutual fund where we invest in India's top companies. Second mutual fund is a debt mutual fund. Debt, as the name suggests, it invests in safe investments. For example, fixed deposits, company deposit, government bonds, government securities, municipal bonds. So these kind of securities, they do not give more than 8 to 9%. However, if I'm in a stage of my life where 8 to 9% is sufficient for me, so and I want my principal investment to be safe, right? I cannot take more risk by investing in companies because companies are quite volatile. Stock market is volatile. So if I do not want to invest in stock market, I can go for a debt mutual fund where I will get unlimited rate of return. However, that is equal to or greater than to your fixed deposits. Okay, so we have discussed about equity mutual funds, debt mutual funds, and the third type of is money market mutual funds, which is also called as a liquid fund. At times we have a requirement to put our money for a very short period of time. We do not want to invest for a long period, 3 years, 4 years. So we want to invest our money for a short period of time, and we want our money to also make some interest, generate some interest, and also we want our money to be safe. So these kind of investors, they go for money market mutual funds where the investment is safe, where they have the potential to generate some interest as well. Around 3% interest per year they can generate in these funds. They are also called as liquid funds. So in case you want to maintain some emergency fund for yourself, let's say we always talk about 6 months of emergency fund, so you can go for a money market mutual funds for 6-7 months of emergency fund. You can 6-7 months of emergencies wherever you want to build that corpus to safeguard yourself. You can use money market mutual funds. So we have discussed 3 types of mutual funds, guys. So if you are not investing in mutual fund, this is the right time for you to start considering it, because you have to beat inflation. You have your savings, you want your savings to grow. Fixed deposits are high tax products, so explore equity mutual funds, debt mutual funds, and for your emergency funds you can take the help of money market mutual funds. Okay guys, so I hope this video was useful, and there is a lot of information available on the internet. You go and check Google, you will learn more. So pick up a book, pick up some manuals, read about mutual funds, different type of mutual funds. I will also talk about it more in my following videos, but I also want you to do some self study. Go to Google, study, pick up some good book, learn from that, so that you build that mindset of how to invest. Okay guys, so I will see you in my next video with more on similar topics. Till that time, you take care. Bye bye.